The housing market is weakening. And that sounds scary, doesn't it? But a weakening housing market can actually mean better buying opportunities than we've seen in years. But to find the best deals in this kind of market, you need to understand why price growth is slowing and whether that's likely to continue, or if you're buying at the bottom right now. So today I'm going to share my analysis to help you answer that question for yourself. This is the BiggerPockets October 2025 Housing Market Update. Hey everyone, I'm Dave Meyer, head of real estate investing at BiggerPockets. Welcome to our October 2025 Housing Market Update. In today's episode, we're going to do a deep dive on home prices because there's more happening than you'd think from just looking at those top-line national price trends. Then we're going to look at inventory and we'll analyze some rent trends and see where those are pointing as we head towards 2026. And of course, like every month, I'll end this market update with my own opinions on where the market is heading next and the actionable steps investors can take right now to align their own strategies with the best opportunities available. Let's get into it. First up, we're going to do this deep dive on housing prices, and we're going to go a little bit deeper than we normally go on housing prices because there is more than meets the eye right now. People, when they're talking about home prices, they tend to look at something called nominal home prices. When you hear the word nominal, that just means not adjusted for inflation. And this is useful. There's nothing wrong with looking at prices this way. It's the price that you probably hear. It's the price that you actually write a check for when you buy something. It's the price you see on Zillow or Redfin or Realtor.com. But it is not the only way that you can look at housing prices. There is another way to look at it that's called quote unquote real prices. And real prices are adjusted for inflation. And although it's maybe not the most intuitive thing or the thing that you hear about most, it's something you absolutely should be paying attention to right now because it really gives us insight into what's happening in the housing market, where growth is right now, and where it might go in the future. And as investors, those are critically important data points that we need to make informed decisions about our portfolios. So we're going to talk about this, and I just want everyone to remember, nominal means not inflation adjusted. That's the price you see on paper. Real means inflation adjusted prices, which I'll explain a little bit more in just a minute. When you look at nominal prices, those are actually still up right now. Depending on who you ask, if you look at the Case-Shiller, they're up about 1.2%. I think Redfin has it at 2%. Zillow has it about flat. So when you look at those nominal prices, it's still doing okay. Now, if you want to get really nerdy about it and seasonally adjust that data, you would see that nominal home prices are down about 1% off their all-time highs, which was back in February of 2025. So given everything that's going on, housing market still doing okay. That's not exciting, exceptional growth, but we are 3.5 years into a very aggressive rate tightening cycle. Affordability is pretty low right now. And so given all of that, to see nominal home prices be somewhat flat year over year, that's actually pretty good. But when you look at housing in that other way, when you look at it in inflation-adjusted real terms, the story is different. It's more different than you actually might imagine. Rather than just being a little bit off their peak, right now, prices in real terms are about 3% below their peak, which actually happened back in 2022, 38 months ago to be exact. So if you think about it in that way, that it's been 38 months and prices have come down a little bit. 3% correction given how fast things grew during the pandemic is not crazy. But when you look at it in this real terms, you actually see that the housing market has already been somewhat flat for the last 3 years. And that's happened even as you've seen the prices on paper go up year after year after year, even though that growth rate has been slowing. And I think this distinction is really important for a couple of reasons. First and foremost, as an investor, I really care about whether my home price growth is at least beating inflation. Ideally, it is beating inflation. You don't want to make an investment in an asset that is going to appreciate lower than the pace of inflation, because when you calculate then your quote unquote real return, it's actually negative, right? If you were to buy a property that went up 1% nominally, and then you subtract the 3% inflation we're at, you actually lost 2% on your return. Now, that's for an all-cash purchase. Leverage kind of changes that situation, but I'm just trying to explain why this is really important, because you as an investor want your property, your asset values to at least go up as quickly as inflation, and that's not happening right now with housing. The second reason this is really important is because I think real home prices help us understand where the housing market might go next and where we are in sort of a historical context. Because when you look at real home prices, it actually tells a very, very different story than nominal home prices. If I were to ask you to guess how much real home prices are up in terms of the pre-crash level, 2006, how much more would you say it would be? Prices have exploded since then, right? So in real inflation-adjusted terms, how much is it up? Is it 50% higher? Is it double? Is it triple? It is actually 10%. Housing prices are only up, when you adjust for inflation, 10% from the bubble period. If you compare to the low, during the crash, 2012, they're up a good amount, 60%, but still nothing close to what you see on paper. People point to home prices and say, oh my God, they have doubled, they've tripled in the last couple of decades. And that is true when you look at them nominally. But a lot of that price increase is actually just inflation. Other assets, other goods, other services have also risen at really rapid rates. And when you look at the last 19 years in inflation-adjusted terms, how much have home prices grown? 10%. And this is actually normal. I know a lot of people make a lot about appreciation in the housing market and say, oh, you should invest for appreciation. But actually, if you look back decades, back to the 1970s, which is what I have good data for, if you look at that, what you actually see is the average appreciation rate in the United States is about 3.5%, 3.4, 3.5%. The average inflation rate is about 2.5%. And so when you look at appreciation in real estate, it's not actually all that much appreciation. You get about a 1.5% quote unquote real return. The rest of it is just inflation. Now, I'm not knocking on appreciation, because one of the best values, one of the most important reasons to invest in real estate is because it's a very valuable inflation hedge. And that is very important right now, in my opinion. So don't get me wrong. I'm just saying that if you want to look at home prices and how they grow compared to inflation, it's really not all that much, historically speaking, which is why I always advocate on the show for investing, not just for appreciation, but for cash flow, for value add opportunities, for amortization, for tax benefits, because appreciation might look good on paper, but when it comes to actual spending power and how much it actually improves your quality of life and contributes to financial freedom, it's not as much as people think it is. So that's why these things are important. But I also want to just explain why I'm telling you this. It's because in the next few years, I think it is very likely that we see real home prices continue to stall out. And that is true, in my opinion, even if nominal prices increase. And this is something I want the BiggerPockets community to be aware of and to think about, is that even if you see prices up 1%, if inflation's at 3%, that is a negative real return. That means prices in reality are actually pretty stagnant right now. So there's a couple ways logistically this could happen. You could see nominal home prices go up a little bit like they are now, and inflation run a little hot, and that means real prices will be down. Or you might actually see both. You might see nominal home prices go down. That is personally what I think is going to happen, probably at least in the next 6 months, maybe in the next year or so, is that we'll see modest nominal price declines, and we'll have inflation at 2 to 3%. And so real returns are probably going to be negative 4 to 6%. I'm just estimating right now. These are not official predictions, but something like that in the next year, we might actually see that. And this is not a reason to panic. This stuff happens in the housing market, but it is pretty important to know, right? If your real return is negative right now, you should be thinking, okay, I need to change my real estate investing strategy based on that reality. And that's something we're going to get to later in this episode, is how do you adjust to this kind of market? Because you absolutely can, and some would argue should, invest in this kind of market because you get great assets at good prices. But you got to adjust how you do it, right? That should be evident to everyone, is that you invest differently in a correcting market like this than you do in one that's growing rapidly. Again, I just think that investing for appreciation, market appreciation, not forced appreciation, is a bad idea, in my opinion, in today's market. The best comp that we have is the 1970s. And what it shows is that during that period, when you saw real home prices accelerate a lot, it started to come down like we've seen here. And it took nearly 7 years. It took 6.5 years for real home prices to recover. Now, we don't know if that's going to happen again, but 6.5 years is not an unreasonable timeline if you look at other data. During the 90s, it took about 11 years for a previous peak. So this can take a while, especially when we have really low affordability. And this is what I want everyone to remember, is that even if nominal home prices grow a little bit, what you really want to look at if you're going to understand when the real big returns are going to come, when you get those outsized gains that real estate can offer you, it comes not when nominal home prices are going up. It comes when real home prices are going up. And in my opinion, that's probably not going to happen for at least this year and probably for a few years after that. That does not mean you cannot invest right now. I think there's very good arguments that you should invest right now because you're going to get assets at a discount, but it does impact your strategy. You need to think differently about a market where real home prices are not growing than you need to think about a market where real home prices are growing. This week's Bigger News is brought to you by the Fundrise Flagship Fund. Invest in private market real estate with the Fundrise Flagship Fund. Check out fundrise.com/pockets to learn more. Before we get into some of those tactical things, I want to just talk about why this is happening. Why are prices stalling out in real terms? And why did I say earlier that I think they're going to continue stalling out in the future? For me, the story is the same. It's the same thing I think I've been saying for 3 straight years now, and I'm sticking with it. The housing market is just in an affordability crisis. I know people talk about the housing market and they think, oh, there's going to be this big crash. The problem with the housing market is not that prices are going to go into a free fall. The problem with the housing market is that more people cannot afford to buy homes, and that is constraining demand, and it is also constraining supply in the housing market, which is leading to this weird sluggish market with low transaction volume and what I think is going to be sluggish or declining real home prices over the next couple of years. If you measure this, and there are ways to measure housing affordability, there's actually just a million different ways to measure them, but pretty much everyone that you look at shows that housing affordability is at its lowest level since the 1980s. The last time it was this low was in 1982, before I was actually even born. And what's actually remarkable to me is that it hasn't slowed the housing market even faster. Affordability has been this low since 2022, essentially, since mortgage rates started to go up. But we have still seen strong demand over the last couple of years, but now inventory is starting to build up. And this can happen, right? You can have a similar number of buyers from 2022 to now, but you just have more people opting to sell. That is sort of the key dynamic that's going on right now, is we have more and more inventory, even though demand is staying somewhat similar. If you read the news or follow the housing market on other channels, you probably see some scary headlines out there that are saying inventory is up like crazy. And there's some truth to that. Like if you look at the best data for this, it shows that inventory is about 17% higher than it was last year. That's a big year-over-year jump. 17% more homes on the market today in any given market than there were a year ago at this time. During normal times in the housing market, that would be quite alarming. But what's important to remember whenever we talk about these things is that when you talk about year-over-year data right now, it's just not that reliable because we've been in this very unusual market for the last couple of years. And so when you look at inventory in 2025 and compare it to 2019, the last arguably normal housing market out there, it's actually still below that. So I think that people freaking out about inventory is a little overblown because we still see it below what is a quote unquote normal level. Now, recent changes do matter. Like it does matter that it's up from last year. That is going to put downward pressure on prices. That's why we're seeing that right now. But I like to put this in sort of historical context too, to make sure that no one's misinterpreting what's going on here and thinking that we're entering some big crash. Inventory can go up for 2 reasons. It can go up because there's less demand, or it can go up because there's more supply. And right now, what's happening in the housing market is it's going up because there's more supply. With more inventory, and because new listings are going up faster than demand, That's what leads to softer markets, right? It basically means that there are more sellers than there are buyers right now. Those sellers aren't pricing things accurately. That leads to price cuts. That leads to better negotiating leverage from the buyers. And that means a softer market where prices are gradually coming down. And of course, this is on a national level. It's different in different markets. But when you look across sort of the entire spectrum of things that are going on in the housing market, you see softening in every market. Even if you are in Milwaukee or Detroit or Providence, Rhode Island, they're some of the hottest housing markets right now. They've gone from 7% year-over-year growth to maybe 3% year-over-year growth. So even if some markets haven't yet turned negative, this dynamic of rising inventory relative demand is happening everywhere, and that's why prices are starting to come down. Now, I want to be clear that this idea that inventory going up and prices coming down might sound scary, but it's actually an advantage to investors, right? This is one of the advantages that will be in the market going forward. Now, of course, I'm bringing this up because it's important that everyone knows that prices are probably going down. This is important information for a real estate investor. And I know it sounds scary, but it really depends on your mentality about it. Because if you're looking to buy great assets at great prices, price declines are actually an opportunity to buy if you adjust your mindset to take a long-term view of the housing market and think about, how do I position myself in the market so that I have great assets when that real home price appreciation actually comes around? Remember, that's what really builds a ton of wealth in real estate investing, is these periods of time that you can't predict perfectly, but there's been many of them over the last several decades where real home price growth really accelerates. You need to be in the market when that happens. And because you can't time that perfectly, the important thing is, how do you find great assets that are going to really have a lot of upside when that real home price grows? And so if you think about it this way and look at the market right now, you say, I have an opportunity to buy assets at lower prices than I've been able to over the last couple of years. Maybe that means I'll be able to get a higher quality asset that's going to grow even faster when that real home price appreciation actually happens. So I'm sharing this because it's important that everyone knows this, but I don't want you all to see this as strictly negative. It is neither positive or negative. Every kind of market has its pros and cons. Con, yes, there is risk in any market that has declining prices. Pro, it means that if you're in this for the long term, you're going to be able to buy better assets than you have been for at least the last 5 years at better prices. That's a significant benefit that you shouldn't forget about. We're going to get more into some of those tactics in just a second, but I wanted to share one more data set before we do, which is about rents. We haven't actually talked about this in our housing market updates recently, but as a landlord, as a long-term investor myself, it's something super important that we should be updating everyone on. So here we go. There are tons of ways to measure rents. There's tons of different methodology. It's actually not as simple as you might think. So I'm actually going to combine a bunch of different data sets, but basically what you see, if you look at all of them combined, is similar to the home prices, is a slowing growth. For some markets, that means it might still be positive. For some markets, that might be negative, but almost every market in the country, the rate at which rent is growing is declining. Every data set I've seen shows that rents nationally are somewhere between 4% positive and negative 1%. And during a normal year, 4% positive would be a pretty good year, but this is way down from the pandemic. When we saw it in some markets, we saw 10, 20, I think in some markets hit 30% year-over-year rent growth during certain years. And so this is just a really big shift. Now, you can break down rent growth into a couple of different categories, and you should, based on what you're investing in. But most of the weakness in rent, or the weaker segment, I should say, in rents right now, comes from multifamily. And that is because during the pandemic, times were very good and a ton of multifamily construction started. And that's still coming online. Buildings that were permitted during 2021, 2022, some of them take 2 or 3 years to build. And so we are still in a historic level of deliveries on multifamily. Deliveries is just a term that means, the unit is getting put on the market for rent. And we have been in this sort of historically high peak of deliveries for about the last year or so. And it is starting to wind down, which is good, something we need to pay attention to that could help rents. But that, to me, is the main reason why rent is slowing down. The other reason it's slowing down is probably because of the economy as well. We are not officially in a recession. I don't think we're in a recession right now, but there are a lot of signs, whether you call it a recession or not, that the average American consumer is constrained right now. We see that 50% of spending in the United States is coming from the wealthiest 20% of people. For the other 80% of people, you're seeing higher delinquencies on different forms of debt. You're seeing lower consumer confidence. You are seeing lower wage growth. There's all sorts of nerdy economic data stuff that points that the average American consumer is constrained. And when that happens, there is less household formation. We're really getting into the weeds right now, but this is important. Basically, when people feel constrained financially, they don't go out and rent a new apartment. As a simple example, if you're living with a roommate and you're feeling insecure about your job or the economy, or you're worried about inflation, you two may not choose to go get 1 bedrooms each. You might choose to be roommates for 1 more year because that's more cost effective. And I know that's just a small example, but if you actually think about that in aggregate, whether it's roommates or families, people deciding to move out of their parents' house, whatever it is, when there's less household formation, that means there's less demand for rental units. When there is less demand for rental units, particularly during a time when there is historically high supply, that's going to push down rents. And it is mostly concentrated in the multifamily market, but it's also in the single family market too. These things do spill over because most renters are just looking for the best deal. And so if there's some brand new apartment and they're offering deals, you might choose to live there, even though you prefer a single family home, but you're getting a better deal on the multifamily. So that's why it can spill over into the single family market. Now, I am not surprised by this. I actually said at the beginning of the year that I thought rents would be flattish this year, and that has mostly been true. Again, Zillow's got it at 2%. Apartment List has it at -1%. Realtor actually has it at -2% off peak. So it's mostly flat. That's where we're at. But at the beginning of the year, I said that I thought that rent growth would pick up in 2026 and that would be sort of a catalyst for real estate investors. And that is still possible, but I just want to be honest with you all that I am feeling less certain about that. My idea at the beginning of the year was that multifamily would work through this giant supply glut that I was just talking about, and then we would go back to the macro context that there's an undersupply of housing in the United States that pushes upward pressure on rent. But the labor market is weakening in a way that isn't exactly how I thought it would play out. Basically, the labor market's getting worse, and I don't think interest rates are really the issue. I know that the Fed is saying like, oh, we're seeing the labor market's getting worse, so we're going to cut rates. I don't think a 25 or 75 basis point cut is going to get businesses to start hiring again. I think we're seeing a weaker labor market, and AI is contributing a lot to that. Whether that's right or wrong, I don't know. I think businesses are like really strongly counting on AI and they don't know if it's actually going to work yet. But I do think just the idea of AI is going to make the labor market a little bit slower to recover. And that's probably going to suppress rent growth a little bit further than I was expecting. Now, I will, towards the end of this year, make my sort of more official predictions for 2026. But as I was gathering the data for this month, it's just something that I've been noticing, and I personally am going to factor into my own investing. Again, not a reason you cannot invest, but it's something you need to take into account as you make a playbook for investing in these conditions. And that's the key to all of this, right? This information, I'm not doing this to scare you. I am giving it to you so that you can use it and make an appropriate and successful strategy for investing over the next couple of years. I have no plans to stop investing in real estate, but I do have plans how to adjust my approach to real estate based on all this data that we're talking about. And I know some of the data that I've shared with you hasn't been the most inspiring or uplifting right now, right? I'm saying that real home prices are flat, probably going to decline. Nominal home prices are up a little bit, but I think they're probably going to start to decline. Some of the things I've been saying about rent growth that I was hoping would start in 2026, I still think that's possible, but it might not be as big of a driving factor as I thought it would be at the beginning of the year. And I know none of these things are exactly what real estate investors want to hear, but I really want to stress something to everyone listening to this, to everyone here in the BiggerPockets community. The market is not your enemy. It is not something that you should fear. You should not only invest when the market is perfect. You should really not even try and time the market. This data is there not to scare you, but to guide you. It actually tells you what you should be doing in your portfolio. It helps you decide on strategies and tactics that will work given market conditions. So yeah, there is uncertainty in this market, but I just want to stress again that no market is perfect. A couple of years ago during 2021, 2022, when there was great appreciation and rent growth, people were complaining because there was no inventory, right? You couldn't buy anything. You had to basically bribe a listing agent to let you go look at a property. You had to waive your appraisal contingencies. You had to waive your right to an inspection, right? There were pros to that market and there were cons to that market. That is the same thing that is going on right now. There are downsides to this market. There is risk, of course, in investing in a market where prices are declining and rents might not grow that much. But there are upsides to this as well. Namely, there are going to be better prices. This is, I feel like, the thing that real estate investors have been asking for years. They've been looking for better prices. They want better assets. They want better cash flow. These are the opportunities that come with a housing correction, right? If mortgage rates stay even where they are right now, and I think they'll probably come down a little bit, but even if they stay where they are right now, if real home prices continue to decline, that means that home prices are more affordable. And even though rents are somewhat flat right now, I do think that they're going to stabilize. And during housing corrections, rents don't tend to go down as much as housing prices. Meaning, when you take those two things into account, housing is getting cheaper, rents are staying the same. That means improved opportunity to generate cash flow. So yes, there are risks, but there are also these benefits to investing in real estate right now. To me, it really comes down to your expectations and your timeline. If you are in this for the short run, it is risky right now. It is riskier than usual to be a flipper, and flipping is always risky, for example. If you need to sell something quickly in this kind of market, there's a lot of uncertainty about that. So I really only recommend flipping or these short-term strategies for people who are very experienced at it or who are willing to take a lot of risk. Because even though there's risk in flipping right now, there's also benefits because you can buy things cheaper, but I digress. The second thing is if you're going to do a long-term buy and hold, I think the key thing here is to really adjust your short-term expectations and have appropriate short-term expectations. This is normal. If you are investing and you need to generate an amazing cash-on-cash return and you want on-paper growth every single year that you hold your property, probably not the right time for you to invest. But honestly, I don't know if there's ever going to be a time for someone with those expectations to invest because that doesn't normally happen. In normal markets, the normal way to invest in real estate is to buy something and hold on to it for a long time. That's how you take advantage of those real price gains that really, really grow your wealth as a real estate investor. So you need to be in the market and you need to be able to hold on to these properties for a long time. That's the game. That's how you reduce risk. That's how you capture upside in the market. And so that's why I recommend to people buying properties that absolutely do cash flow, that are easily held on to for the long time, are in a great location, but don't expect that this is going to make you rich overnight. It might take 2 years. It might take 3 years. It might take 5 years for you to get the maximum benefit of owning that property. But not only is that okay, that is the normal way to invest in real estate. That is what you're supposed to be doing. There is a reason that institutional investors, professional investors, when they do a syndication, when they raise money from other people, their hold period is usually 5 to 10 years. And there's a reason for that, because when you buy real estate, there's all these transaction costs. There are amortization changes of the way your loan is structured. And to get the right benefit from real estate, you need to hold on to it for 5 to 10 years. And that's absolutely still true. So if you go into this market with that mindset of thinking, I am just trying to buy great assets at great prices, and I'm going to hold on to them for 5 to 10 years so that I can capture the next spurt of real price growth, that's the right mindset. That's how I'm approaching this personally, because I can buy assets cheaper than I could a year ago or 2 years ago or 3 years ago, especially in real terms. And that means I'm going to be able to not just hold on to these properties because I'm getting them for a cheaper price, but it means my basis is lower. So when those real price gains do come, and they will come, it always comes back, that I'm going to have an even bigger return than what I would have had if I bought it a year or 2 or 3 years ago, because my basis, my purchase price is lower. So that's my best advice for how to invest in this. Don't think of this market as your enemy. Just think about your expectations and your goals. The reason to be a real estate investor is because it grows wealth over the long term. And if you go into it with that approach, I really think you're actually going to see that there's going to be fantastic opportunities in the real estate market. Just this morning, there's a market in the Midwest that I invest in. My agent sent me 4 deals for small multifamily, 4 small multifamily deals that all met the 1% rule. I haven't seen that since 2019, something like that. This is the first time in years I feel like I can be picky. I can look at these 1% rule deals and say, no, I don't like that. Not good enough location. Or I can buy a 0.9% rule because it's in a great location. Like, these are options that I haven't had in years. And I encourage you to take that sort of mentality. This is the time that you get to be a selective buyer. It's the time where you can value precision over scale. And if you take that approach, there's a very good chance that you're going to be very happy with the decisions you make right now, 5 to 10 years from now. That is the way that I am approaching real estate right now. And I think for the majority of investors, I don't know all of you, so I can't say for certain, but that's the way I recommend the majority of the people in the BiggerPockets community, people pursuing financial freedom, think about real estate investing right now. I think it's a time to actually be excited and to think about buying opportunities and not to let the fear of these headlines force you to miss the opportunities that will exist. All right, that's what we got for you guys today. Thank you so much for listening to our October 2025 housing market update. If you have any questions about this, please let me know. Drop them in the comments on YouTube, drop them in the comments on Spotify. I am happy to answer questions, or I do it on Instagram as well, where I'm at The Data Deli. Thanks again for listening. We'll see you next time.